Welcome back to another video. In this video, we're going to be looking at Lemonade Insurance, ticker symbol LMND, the insurtech company that went public earlier this year. The stock has been on a bit of a ride since the IPO, hitting $85 after 9 days, only to drop back down to $45 2 months later. The stock has since marched back up, closing at $74. Funny thing is, throughout the whole process, no real changes in the business occurred, apart from some changes in the way they have to report GAAP financials. For disclosure, I do own some Lemonade. I managed to actually buy around $49 in September when the stock was near its bottom. And although I own some stock, it's a very small percentage of the portfolio, so not a huge conviction bet. At the end of this video, hopefully you will understand why I haven't made a large bet on the stock, but also understand why I bought it. So I wanted to do a video on Lemonade because it's a very hyped up stock and company, but I'm not sure the majority of people have actually been able to wrap their head around the business model and more so the financial metrics of the company. I have a lot of knowledge of the insurance industry and have worked with a variety of insurance businesses, so I think I can provide some value in explaining how Lemonade works and demonstrate in a financial model what it needs to achieve to be a successful investment for shareholders from here. So firstly, what is Lemonade? So Lemonade is an insurance company based in the US and Europe that delivers insurance policies and handles claims through desktop and mobile apps, using AI as its primary method for underwriting and paying claims. Lemonade's business model differs from that of an insurance company due to its AI function, solely online way of transacting, its reinsurance structure, and most of all, its give-back promise, which pays a certain amount of excess premiums to charities of the customer's choice. They have some notable backers, including Google, Sequoia, SoftBank, Allianz, and AXA. You may have noticed that two of the backers I just mentioned are two of the largest insurance companies in the world. So this is quite interesting to consider. We're going to play some clips from a video that Lemonade put out recently just to get some more background on the company and listen to what they have to say about where Lemonade is going.
CNBC ranking the 50 startups with the best chance to end up as multi-billion-dollar companies. It is our Disruptor 50, and all this week we're introducing you to these companies. And right now on this show, let's meet Lemonade, not the drink or Beyonce album. This is an insurance company. And joining us now is Daniel Schreiber. He is co-founder and CEO of Lemonade, a company using AI, artificial intelligence, to change the game in insurance. Daniel, welcome. I guess that's why we call them disruptors. How are you using big data and AI to change an industry that seems like it hasn't changed in half a century?
Good morning. Yeah, I'd say a couple of centuries. So the whole insurance industry has been around for hundreds of years. The companies that dominate the Fortune 100, 12 of them are insurance companies with an average age of 125. So this is absolutely a sector with tremendous amount of legacy. And what we're seeing today is that all of that legacy is turning from an asset into liability. If you've got 40,000 brokers, is that an asset or liability?
Industry that seems like it hasn't changed in half a century.
Good morning. Yeah, I'd say a couple of centuries. So the whole insurance industry has been around for hundreds of years. The companies that dominate the Fortune 100, 12 of them are insurance companies with an average age of 125. So this is absolutely a sector with tremendous amount of legacy. And what we're seeing today is that all of that legacy is turning from an asset into liability. If you've got 40,000 brokers, is that an asset or liability? If you've got a tech stack that you've been building since the 1970s, is that an asset or liability? And Lemonade has started from scratch, so we have none of that. And we've been able to build a company that's purely built on top of a digital substrate with AI and behavioral economics as our foundations. And what that means is that consumers can buy insurance in a matter of seconds from their smartphone, chatting to a chatbot. They make claims the very same way. And about a third of our claims are settled within 3 or 4 seconds by a bot on your app.
But how do you, Daniel, how do you do that, though? I mean, how does the bot know what's right, what's wrong, whether or not, listen, I hate to call people out, but insurance fraud is a big deal. How does the bot know if somebody's not just pulling a fast one?
Well, AI is getting to the point that for certain tasks, it can reach parity with humans or even outperform them. So there's pretty sophisticated algorithmic work happening behind the scenes. This isn't a dumb bot, it's an incredibly smart one. And it's particularly good at flagging fraud. Now, for us, dealing with fraud is not just about the algorithms and the AI, although we do that, and of course humans are fallible as well. It's also about changing the business model. So insurance companies typically make money every time they deny a claim because they keep that as underwriting profit. And Lemonade works differently, where we take a flat fee, and if there's money left over at the end, it goes to a non-profit. And that changes the dynamics such that our consumers are less inclined to defraud because they know that they're not cheating from a nameless, faceless behemoth with whom they have a conflicted relationship, but from a charity that they have designated as important to them. So we deal with fraud both through social impact, having a give back program where that brings out the best in us and the best in the consumers, and through really smart bots that can analyze data and detect any kind of variance or any kind of suspicious behavior, arguably far better than a human adjuster could.
Okay, so if what you're saying is happening, and I'm the CEO of one of those Fortune 50 companies you talked about, Daniel, I'm going to do one of two things. I'm either going to try to crush you or I'm going to buy you.
Well, State Farm, just a few weeks ago, State Farm is the largest insurance company in the nation. They're 1,000 times bigger than we are. And they issued an advertising campaign with Oscar Nunez from The Office, mocking our company and mocking bots and talking about how consumers don't want bots, they want a State Farm agent. And I've got to say, we really love that because, first of all, a company 1,000 times larger than us taking an interest and feeling threatened by us quite seriously is a compliment. But also it designates, it delineates the battle lines, if you like, between the old school and the new. And it gives consumers a very stark choice. If they want to go with a broker-based model and pay the additional costs and deal with faxes and paperwork and everything that entails, that is amply available to them. But if they want to go with an insurance that is seamless, paperless, instantaneous, that's also available. And it's very difficult for an incumbent to switch from being the one to the other. They're so invested in their existing systems that I think those battle lines are drawn and they'll be with us for a while.
How is Lemonade disruptive? So to answer this, firstly, we need to look at the insurance industry as a whole. So the insurance industry is huge. The total addressable market is almost 6 trillion globally. It's one of the largest but oldest industries in the world, and not much about insurance has changed in almost 100 years. So the same insurance companies that existed 100 years ago are still the leaders today. They turn over billions in revenue each year without having to adopt a customer-centric business model. About 80% of insurance companies still use unnecessary chains of distribution to sell insurance, otherwise known as brokers or agents. This inflates the overall cost of doing business, therefore inflating premiums, which the customer ends up having to bear the cost of. Most insurance companies also still use humans for underwriters, actuaries, claims handlers to analyse data sets, manage risk and set coverage terms. This screams to the lack of innovation in times of technological boom. And what some insurers have credited as innovation in recent years has been able to get a quote for home insurance via their website. The Lemonade strategy, I'm going to call it the trifecta of disruption. So Lemonade are very much the contrary to the rest of the insurance market. They have a very customer-centric business model by trying to avoid unnecessary acquisition costs. They save the customer premium as well as offering a super fast point of sale and purchasing process. And this is coupled with a super fast claims settlement process as well. These factors contributing to the customer-centric business model are very effective in both winning new customers and retaining existing ones. So think of how well this strategy worked for Costco and Amazon as an example. Lemonade were also the first to adopt AI machine learning as the primary underwriter, actuary, and claims handler. This, of course, has cost benefits over time, but really it's the effects it can have on your underlying results that matter the most. So the majority of the world is waking up to the fact that AI is better than humans in predicting patterns and analysing large sets of data. This thought seems to be passing on to the insurance industry, albeit at a slow and not significant pace. Next, their culture and brand also differs greatly from the insurance market due to their refreshing business model and give-back feature. Their brand has also been boosted by the fact they can deliver a product quicker and more efficiently than anyone else in the market. Lemonade's business model, can it work? So Lemonade's business model, simplified, is first, they sell insurance to customers via an online mobile app. Secondly, they retain what they call a flat 25% fee of the premium and then in return take 25% of the claims liability. They pass the remaining 75% of premium and claims liability to a reinsurance company. They also receive what is called a ceding commission a common practice in insurance of 25% for every dollar placed with the reinsurance company. So that comes to about 25% of the 75% they place with them. This equates to 19% of the total premium. So this brings their total take of revenue to about 44% of the gross premium, with only 25% of the exposure to claims. Once they've taken their 25%, transferred the premium to reinsurers, settled all claims, they calculate what is left over from their 25% rebate, that is, so not total premium, not their original 25, and definitely not the reinsurer's money, as they can't play with that. They give a portion of the leftover money to charities that are chosen by their policyholders. They calculate this with their own charity to policyholder cohort method, making it almost impossible for investors or outsiders to actually estimate what this will cost them on an annual basis. Lemonade have, however, given some guidance and said it should usually equate to about 1.5% of gross premium and gradually get larger, get slightly larger, maybe creep up to 2% over time as the loss ratio starts to get better. Now, let's talk about reinsurance and ceding commission. So, first of all, you will need to understand what reinsurance actually is. As I've watched some videos on Lemonade, and I think people are a bit confused on its purpose or about its purpose. ARK Invest probably being one of them. If I'm honest, I'd like to provide a bit of clarity if I can and add my opinion. So, reinsurance is insurance that the insurer buys for itself to cover a portion of the losses and minimise their downside. So, for example, if I'm the insurance company and you buy home insurance from me at $1,000 of premium, your house is valued at, let's say, $100,000. So my total exposure or maximum payout is $100,000. Say if you had a fire and burned a house down. Now, as the insurance company, I'd like the comfort of knowing that I will not have to pay out that much if you do have a fire. So I go and visit a reinsurance company and ask them to reinsure the house for me. Now, I'd only like to have about 50% exposure to the 100,000. Therefore, I'm going to ask the reinsurance company to reinsure 50% of the house for me. The reinsurer agrees to share 50% of the exposure. In exchange, they take $350 of the $1,000 that you paid me. This is net of rebate and ceding commission. So this is $350 they charge me after they give me back the ceding commission, just for simplicity. So now my total exposure is only $50,000 or 50% of the exposure, but I have managed to retain $650 of the premium, or 65% of the premium in total. So you can see why it seems attractive to insurers, especially one like Lemonade. Now, it would take all day to go through all of the different reinsurance programs and why you can layer the programs. You have proportional, non-proportional, excess of loss, and retrocession, which is basically reinsurance for reinsurers. So it would take all day to go through them, so that's not what we're going to do. But that's how the fundamentals work, and that's a program there that's very similar to Lemonade's. Okay, now to clarify ceding commission. So for someone who doesn't have inside knowledge of insurance and the insurance world, giving back commissions in this scenario might seem strange. Why would the reinsurance company pay you for them to protect you? Well, it's actually fairly common practice, and I'll walk you through the thought process. So when an insurance company passes over premium to the reinsurance company on a portfolio level basis, they are essentially passing over business that the reinsurer wouldn't otherwise have access to and doesn't have to acquire themselves. They also don't need to pay for various operating and acquisitional costs, such as sales and marketing, a user-friendly system, individuals such as a claims handler for individual claims, or an underwriter for individual underwriting. Therefore, the only real cost that they bear is their share of the claims. So if the loss ratio is low enough, then it can be a very profitable venture for reinsurers without having too much frictional, I don't know, I've got fictional there, frictional or operating costs. Now, Lemonade's potential for growth. Let's first think about the total addressable market, the insurance market as a whole, and what sort of impacts that has on Lemonade and Lemonade has on the market. So there's no disputing that Lemonade is a real disruptor in the insurance industry. It's great potential for growth to get much larger than its current capitalization. Usually when people are scrambling to copy you, it is a good sign. And I do have a good feeling about Lemonade, I must say, more so what it represents. It represents progress in the industry, if I'm honest. So to start and operate an insurance company the way that Lemonade has is very difficult. You ideally need to have no legacy. So ideally not to be an insurance company before that. You need to really forget about what you think you know about insurance. So ideally not be from the industry, and also adapt your mind to a different kind of business model. When factoring in the give back approach, giving back part of your profits isn't something insurance companies or companies in general tend to do. So this isn't to say that there won't be viable competition in the future for Lemonade. There already is. But insurance is by nature and always will be a very saturated market. After all, it is a $6 trillion industry globally. There's plenty of room for competition to coexist, especially for a disruptive company that's valued only at $3.5 billion. Some insurers who turn over $100 billion in revenue only have 4 to 5% segmented market share, not even global market share. Now, in my opinion, too much pressure gets put on some of these disruptor companies, and Lemonade especially, to change the industry completely that they're in. That Lemonade, in this case, only have to play a role in the $6 trillion market to be a success story and a great investment from here. It is likely that Lemonade will not change insurance on its own, definitely not overnight and definitely not over a 10-year period, but I feel confident that it will appeal to a segment of the market and likely dominate that segment. So let's say, for example, they're only able to, or they appeal to young buyers of insurance under 35 as an example, and it stays that way in the US and Europe. And due to their business model offering packaged products, those young customers spend or purchase 2.5 to 3 policies a year from Lemonade, getting them to about $700 to $900 premium per customer each year. Although I don't have an exact figure, that's still a very, very large addressable market, especially when you compare it to the $3 billion market cap currently. So I'd say let's focus less on if Lemonade is going to change insurance forever, and be a bit less vague and think about what sort of success can they achieve within the area of the market that they appeal to, and how big of an opportunity does that look like in the future, and as always, compare it with the current price we are investing, after all, not pretending to have a crystal ball. Now, to give you an example, this is potential for growth and what's required, but really I just wanted to give an example of how top line growth is not really hard to come by in insurance, as long as you are okay to fulfill the contract, i.e. pay the claim. Growing whilst managing the loss ratio is the difficult part. So to give you an example, a new startup in London called Convex has estimated in 2021 their top line revenue will be $3 billion. This is a company that started operating in 2019, and you've probably never heard of them. They plan to reach 4.5 to 5 billion in the next few years, and although they had to raise a few billion in equities to support this growth, it's still a huge amount of growth in a very short amount of time. Lemonade's future success will depend on these 6 factors below here. So its ability to attract new customers to the platform, which it will likely do through building up its brand awareness. Also, its ability to retain existing customers. So, can it still offer competitive prices? Can it keep customers happy? Next, its ability to expand into new geographies, which it's done. It's expanded into Europe. It's looking at certain countries in Europe first and then trying to move into others. Next, its ability to grow premium per customer by expanding coverage. Now, this is one of the real KPIs that they always seem to mention, how well can they grow that premium per customer number by getting existing customers to, go with them on renters, go with them on pet insurance, go with them on life insurance. That really is the Lemonade model. So their ability to do that will be a factor of their success. Also, their ability to innovate into the future. So we've got AI and machine learning right now, but what's going to be the new thing in 10 or 15 years, and how well can they adapt to that? That's going to be a factor. And also the next factor is the ability to manage risk and the loss ratio. So this is going to be really key in what their bottom line looks like, but also it's going to be a massive factor in whether they can keep their reinsurance contracts. So all of these things will be major factors in Lemonade's future success. Okay, so risks and going concerns. So first of all, insurance by nature is risky. After all, you are being paid to manage risk. Insurers usually experience quite predictable and steady top-line revenue. due to the recurring revenue streams that annual contracts provide. But they usually experience wildly fluctuating bottom line results due to unforeseen catastrophe losses every now and again, like hurricanes, wildfires, earthquakes, as well as explosions and fires within properties and things like that. So some years are great, some years are very bad. So the first risk for Lemonade is the reinsurance risk. So Lemonade's trying to mitigate those fluctuations by transferring most of its risk out to reinsurers, which is useful until the reinsurance company, which is Lloyd's of London, decide to either pull cover, leaving Lemonade with increased exposure, or the inability to write new business, or the reinsurance program becomes more expensive, so they push pricing up for the cover, therefore reducing Lemonade's already quite tight margins. The risk factor will mostly depend on Lemonade's loss ratio and how well the AI performs in terms of improving that loss ratio, and the condition of the reinsurance market as a whole. Next thing is growth is slightly at the mercy of liquidity. So an insurance company unfortunately can't just grow premium at 100% without increasing its liquidity position or cash reserves to pay any potential claims. That's regardless of its reinsurance arrangements. So this has to be factored into Lemonade's growth plans. They likely will have to raise more capital to grow at the rate which they want to, as they're not producing enough cash to support the increased capital requirements. So this will probably lead to some share dilution or the issuance of debt over time, which is not ideal for shareholders currently. Next is there's no guarantee that they can actually become profitable. So Lemonade's potential margins are already very thin when you look into the future and measure against a gross premium number, rather than their abbreviated operating revenue. So although it's less vulnerable to fluctuations with the current reinsurance program, they don't leave much room for the bottom line. And as mentioned, there is always the possibility that the cost of reinsurance will go up over time. They've currently got a 3-year reinsurance contract. Some of the part of the reinsurance contract, which I think will probably be the catastrophe part, renews annually. So that could always change. And as you'll see in the valuation, it's not quite obvious how the bottom line will play out, and it is fairly hard to calculate. So now we've covered Lemonade, the business, how it's disrupting insurance, the reinsurance market, and the potential growth and going concerns. Let's look at the valuation that I've done for Lemonade. Okay, so here we are in the financial model or valuation for Lemonade. Firstly, I'd just like to say that this is quite a complicated and high assumption financial model, meaning its accuracy should be taken with precaution. Because of that, do your own work on the financials and decide if you think the assumptions will likely or are likely to play out. I'll be honest and say I'm not hugely convinced that they can make these margins work, just especially given we're forecasting them out 10 years into the future, and there's so many variables that we mentioned earlier to the success of Lemonade's business model. But anyway, this is the best that I could come up with, and still trying to be quite conservative, especially in the margin element of it. I just wanted to demonstrate in the way of a forecast what a success story would look like for Lemonade and what sort of return you can expect if that plays out. So I'd describe this valuation as bullish just for the fact that if they can achieve these metrics here that we've got, it will be seen as, in my eyes, a major success story. All right, let's go over the assumptions that we have here, because we have got some assumptions. So we've got customer growth growing at a 35% compound annual growth rate, is currently growing at about 100% to 55, 60 at the moment, but we're saying that's going to slow over time because obviously it is. Premium per customer, they're managing to grow that about a 15 to 20% rate at the moment, but we're going to say it's going to go to 15, 16% over the next 10 years because they're going to introduce some more products. They haven't introduced that much at the moment. That part of their business should come in sort of some later years. So 16% we've gone with. Net loss ratio is going to creep down to 60%, currently at 70 or 72, looking like it will be 65 by next year. We're going to say it's going to creep down to 60%, which 10 times EV to EBIT, increase in shares of 1%, operating revenue as a percentage of gross premium will keep that at 45%. So the assumption there, underlying assumption, is basically they keep the reinsurance program that they have at the moment for the next 10 years. The giveback's going to be 1.5% to 2% of GWP. Sorry, that shouldn't be 1 to 5, 1.5. 1.5 to 2% of GWP. It's currently 1 to 1.5, so that's going to grow as the loss ratio starts to improve. Operating expense growth is going to grow, so the operating expenses here made up of this is going to grow at 27.5% compounded annually, which is a little bit below the customer growth rate, but we'll get into that. Okay, now let's start with these financial metrics here, so Lemonade's actual financial measures, and see how we can correlate them with a more regular business. So first of all, here we've got the premium generated, gross written premium, which really could be seen as the top line for Lemonade. It would be the top line in any other company. We've got the two KPIs for this are the customers and premium per customer, which the whole model sort of relies on. So as we mentioned before, we've got customers growing at 35%. This gets them to 19 million customers in 2030. And to give you a little bit of a comparison, AXA, which is a huge insurance company in Europe, has 108 million customers. Geico has 26 million customers, but only in the car insurance industry. So 19 million will be a very good amount of customers to achieve if they can do that. Premium per customer growing at 15%, as we mentioned, that gets them to $920 of premium per customer in 2030. And when you factor in that that's around about the industry average anyway for most insurers that are offering monoline or just one line of insurance. So 924, as long as they can expand on those products, that seems doable. That gets us to our gross premium, 17 billion gross written premium in 2030. And I've got up here a few notes just to give you a comparison of what that looks like in the market. So we're saying the gross written premium will reach a similar size to that of McFree, The Hartford, and SCOR. So you've probably never heard of them, which is exactly the point I'm trying to make. You don't have to have significant market share to be a successful company in insurance. So the top line here is also only about 7.5% to 12% of some of the market leaders, Berkshire, AXA, Allianz, and State Farm, what they currently do today. Lemonade's revenue, let's look at this here. So this is quite an important factor. We've got the 25% fee that they take initially. All right, this is what they say is their 25% fee. We've then got the 25% of the 75% rebate that they get, or the ceding commission. So this is the revenue left after all the premiums have been ceded and paid to the reinsurance company. This leaves Lemonade with about 44 to 45% of GWP. In other words, it is a 45% gross profit. You could look at it if you're looking at GWP as the top line. Gross profit, cost of revenue, we're estimating that they achieve a loss ratio of 60% in the future, which isn't as good as what they're actually aiming for, but I'd question how low that amount can really get, especially for an insurance company growing top line so quickly, as well as the fact they're diving into new geographies and product lines. We can't have it both ways, unfortunately, but 60% is still a top quartile loss ratio in the insurance industry. So it's still not going to be, easily achievable for them. They're still going to have to do a lot of work to get down to that. Operating expenses, the give back, sales and marketing, tech development, general administrative. Operating expenses actually here are just calculated as these three, but I've calculated these individually. But to summarise, it's going to be growing at a similar rate to the number of customers, a little bit lower than that, but they have a distinct relationship and correlation with each other in that regard. So I've gone with about a 28%, 27.5% compound annual growth rate over the time. Sales and marketing is going to slow as the give back becomes sort of more of the marketing payment, if you like, because they expect their marketing strategy to change to more of a spread the word and word of mouth kind of approach. And I do think the annual give back will be a big contributor to this. Right, this brings us to EBIT, or operating income. So based off of our estimates, in year 10, Lemonade will have an EBIT, or operating income, margin of 8%. If we're considering that's GWP as the top line, if we're considering operating revenue as the top line, then the EBIT margin looks a little bit more attractive at 17.5%. So it depends which way you want to look at it. Lemonade are looking at it as that's their top line, and they've actually got a fairly high margin business. I'd look at it as they're an insurance company, as their top line being this. So the EBIT margin is only at 8%, which when we actually compare that to other companies in the industry, i.e. some of these companies, they actually have slightly worse off margins than a Chubb or a Travelers, or not so much Geico, but definitely a Chubb and a Travelers. So that gets us to 1.3 billion of EBIT or 1.4 billion of EBIT in year 10 if we use an exit multiple of 10 times EV to EBITDA, or sorry, EV to EBIT. That's actually probably one of the most conservative assumptions of the model and forecast, if I'm honest. At 10 times EBIT for a company that at that period still going to be growing top line at about 25% and grown at 35% over the 10-year period seems unlikely, but I didn't want to go any higher than 10 times EV to EBIT just because insurance companies do not tend to sell for that much higher than 10 times EBIT anyway. But if you look at it as a tech company, then of course, relative valuation would say this should be higher. If you're factoring it as a tech company, it'd be more like 20 times EV to EBIT. But I'm going to go with the more conservative number of 10 times on this occasion. So if we add back the cash, it's 575 million at the moment, and debt is zero, we get a terminal value of 14.5 billion in 2030. So another comparison for us to look at here is, what is this a similar market cap to? So what are we saying that this sort of value is going to be similar to in year 10? So it's a similar market cap to Arch, Markel or Fairfax currently. This market cap actually wouldn't even get them in the top 50 largest insurance companies today by market cap. That's today, let alone in 2030. So again, just reiterating, we are not predicting that they kill the entire insurance industry with this forecast. Not at all. We're actually predicting that, yes, they have very successful results, but we're predicting that they don't actually make that big of an impact in the industry anyway, at least financially. So in this scenario, we could expect a 17% annual rate of return from buying Lemonade today, off of the stock price of $69 per share. So just repeating what I said at the beginning, these are obviously my predictions. They could easily be wrong, and it's definitely not a business that everyone has been able to understand very easily, and it has huge potential if it can execute on its business plan well, but it also has a lot of risk involved, so which is mainly the reason why I wanted to make a video on it. But hopefully it's provided some value in clarifying exactly what Lemonade does and what it needs to do in order to be a successful investment from here. So a good way probably to look at this is use it as a benchmark. This whole forecast here, use it as a benchmark. Firstly, see if you can, going back to the slides earlier, see if you can wrap your head around the business model and the financials, and then decide if you think these estimates are either not possible, or probable. If you work off that basis, that will probably give you an easier route into investing into Lemonade today. So if you think that it's probable, very probable that they can achieve this, it may well be that Lemonade is a good investment for you at this price, given that you could achieve a 17% annual rate of return. However, this is not advice to buy the stock, just my opinion. Okay. So thank you for watching. Be sure to subscribe if you'd like to be notified when the next video is posted. I've already started on some other companies that are a little bit less complicated and a little bit more mature, but still in high demand. So hopefully I can get them out very soon for you all to watch. Until next time, good luck with your investments.